Asset markets can be choppy with no real gains, which can be frustrating for investors as they have sacrificed the fruits of their labor today and with the hopes of their money gaining significant value over time. That hope is realized in the form of bull markets. Bull markets are the reason investors play the game of investing. The biggest gains of wealth happen during bull markets. So what is a bull market? A bull market is a period of time when asset prices rise significantly, backed by positive investor sentiment, usually stemming from a positive outlook on the economy and some new technology or innovation that promises to bring efficiency to the economy and, of course, more GDP growth. Bull markets make long-term investors wealthy and suck in new investors who believe they can get rich or die trying. We're going to take a peek at what drove the 5 strongest stock bull markets in the past 100 years to get a better understanding of what gets investors most excited about the future. The 1920s was a decade of productivity and prosperity. From advancements in aviation, the mass production in automobiles, the rise of radio and broadcasting, and the rise of the film industry where Hollywood was born. Companies like AT&T, Ford, General Electric dominated the stock market. The foundations were laid for Disney, Delta Airlines, IBM, and Caterpillar. From 1921 to 1929, the stock market gained 500%, often regarded as the greatest bull market in history. Low inflation, low interest rates, abundant credit, and rapid GDP growth. This era was known as the Roaring Twenties. Next, we have the 1950s, an era of rapid population growth, credit, and more innovation. Credit cards laid the groundwork for the modern credit system. The transistor radio enabled people to listen to music and news on the go. And commercial jets made air travel faster and more accessible. ExxonMobil and General Motors dominated the stock market. Massive consumer spending led to the rise of McDonald's, Domino's Pizza, Baskin-Robbins, Burger King, and Holiday Inn. The combination of population growth, credit growth, and innovation made the 50s one of the most explosive stock markets in history. From 1949 to 1957, the stock market gained 220%. This was the baby boomers era. The 1980s were marked by the rise of computers. The compact disc revolutionized the music industry due to superior sound quality and durability. Personal computing changed the way people worked, communicated, and accessed information. The World Wide Web gave the ability for computers worldwide to connect and exchange data, which led to an era of global interconnectedness. This era was dominated by IBM, while the foundations were laid for Dell, Microsoft, Cisco Systems, and Adobe. From 1982 to 1987, the stock market gained 250%. Driven by deregulation, government spending, and computing technology. This was the technical revolution, the beginning of an entirely new industry. It laid the groundwork for what would come next. The rise of the internet happened in the 90s. Search engines revolutionized how people found information. Mobile phones reshaped everyday life. E-commerce enabled online shopping, and Wi-Fi allowed electronic devices to connect wirelessly to the internet. Microsoft and Apple dominated while the foundations were laid for Google, Amazon, eBay, and Netflix. This was the beginning of the tech sector. The stock market rose 400%, but the tech sector grew 1,800%. From here on, the bulk of GDP growth would shift from industrial manufacturing to software and online services. No longer would the largest companies come from energy, automotive, or finance. They would become technology companies. This was the internet boom. From 2010 to 2020, the stock market would be dominated by digital economies, internet applications. This is the digital age. In the digital age, streaming technology allowed users to access vast libraries of music, movies, and television shows on demand. Cloud computing technology allowed for storing, managing, and processing data over the internet rather than on a local server or device. Smartphones combine the capabilities of a computer, a camera, a telephone, all in a single handheld device. Social media platforms reshaped personal relationships, global politics, public discourse, marketing strategies, and even activism. Apple, Amazon, Google, Microsoft, Facebook, and Netflix would lead the way, and the foundations were laid for Spotify, Uber, Airbnb, and Bitcoin. The stock market would gain 225%, driven by these digital economies. Now let's fast forward to 2022. Inflation's at a 50-year high, GDP is negative, and investor sentiment is extremely depressed. All hope is lost. But from the ashes came ChatGPT, an artificial intelligence platform that saw the fastest adoption of any technology in history, gaining 1 million users within the first 5 days of its release. The market ripped higher and went on to crown NVIDIA as the king of AI and the largest company in the world. The AI narrative prompted hundreds of billions of spending into production, construction, data centers, chips, software, and electricity, fundamentally changing the future of knowledge work and kickstarting another bull market. Today, AI is believed to become the most productive technology in human history, rapidly increasing the production of goods and services for a tenth of the cost. Now you know what ultimately drives bull markets. Sure, supportive financial conditions and positive GDP growth help markets to grow. But the most explosive aspect driving bull markets are innovative technologies that spread into different sectors, increasing productivity growth. Next, we dive into what drives the opposite, bear markets.